What if I told you that the very foundation of the market models you've been taught, efficient markets, rational expectations, and the perfect trader who always calculates optimal outcomes, is a fantasy? You've probably felt it before. That sinking frustration when the chart sets up perfectly. Your entry is flawless, the probability looks stacked in your favor, and then the market behaves in a way that defies logic. That's the moment when Richard Thaler's Misbehaving comes alive for you. Because the truth is, the market doesn't operate like the textbooks say, and neither do you. Thaler's central argument starts here. Traditional economics assumes people are rational. They assume you, as a trader, will weigh every possible outcome, assign probabilities, and act like a machine programmed to maximize expected value. But deep down, you already know you're not that machine. You're human. You hesitate when you should pull the trigger, you average down when your plan says cut, and you've definitely chased a green candle because you didn't want to miss the move. That gap between what the models expect and how you actually behave, that's misbehavior. And it's the birthplace of behavioral economics. Thaler recounts early moments in his career when he noticed strange inconsistencies. For example, in experiments where people were asked to value objects, they priced them differently depending on whether they owned them or not. In theory, ownership shouldn't matter. An asset has an objective value. But in practice, the endowment effect skewed people's decisions. Imagine it in trading terms. You buy a stock at $50 and the market moves against you. Now, instead of accepting the $45 fair value, you cling to your $50 entry as if the market owes you. Rational? Real? Absolutely. This is where traders often set themselves up for pain. The rational models, what academics call efficient market hypothesis, EMH, tell you that prices reflect all information and deviations are random noise. But you and I both know markets are human theaters, full of emotion, herd mentality, and mispricing. If you take EMH literally, you'll stop questioning yourself when you're caught in bubbles, panics, or illogical moves. Thaler's critique is simple. Humans misbehave, and those misbehaviors shape markets. Now pause for a moment. Have you ever trusted a system or indicator so much that you ignored your gut screaming, "This doesn't feel right"? That's you trying to force yourself into the rational model box. Thaler would tell you, you're not wrong for feeling that tension. You're simply being human. The mistake is pretending you're not. Think of the 2008 financial crisis. According to rational models, it couldn't have happened. Traders, investors, and banks were supposed to behave logically. Risk was supposed to be diversified. Prices were supposed to reflect reality. But what actually happened? Overconfidence in models, blindness to black swans, herd behavior, and plain greed combined to create catastrophic mispricing. In Thaler's language, everyone misbehaved, and the global economy paid for it. When you step into the market each day, you're playing inside this gap between theory and behavior. That's why Thaler's work matters to you as a trader. If you cling to the myth of rational markets, you'll never truly understand your own mistakes. You'll blame randomness or bad luck. But if you accept misbehavior as reality, you open the door to adaptation. You can begin asking better questions. Where do I misbehave most? How does my psychology distort my execution? Which parts of my plan are vulnerable, not to the market, but to me? Compare this to Mark Douglas's Trading in the Zone. Douglas insists that your edge isn't prediction, it's consistency. He says the market is random, but your behavior doesn't have to be. Thaler gives you the evidence for why Douglas is right. Misbehavior is baked into every human brain. You can't remove it, but you can learn to design systems that account for it. Richard Thaler echoes this in The Mental Game of Trading when he talks about mapping tilt patterns and building emotional discipline. They're all circling the same truth Thaler uncovered. Markets are human, not mechanical. You'll notice a key shift here. Instead of asking, how do I forecast the market better? You start asking, how do I forecast my own behavior under stress? That shift is revolutionary. Because the greatest cost in your trading isn't the occasional losing trade. It's the repeated behavioral mistakes you don't control. Thaler's stories also reveal another powerful point. Most economists resisted his ideas at first. They wanted to preserve the purity of rational models. But slowly, reality won. The data piled up, the anomalies multiplied, and behavioral economics became impossible to ignore. You can see yourself in this struggle. Maybe you've resisted the truth about your own trading habits. Maybe you've told yourself, I'll just find a better setup, a better indicator, a better market. But what if the problem isn't the setup? What if the problem is the gap between the rational trader you want to be and the human trader you are? That's why this book isn't just history. It's a mirror. Every time Thaler describes how real people misbehave, you can find a trading parallel. The next time you get stopped out and feel the urge to re-enter instantly, remember, that's misbehavior. The next time you hold on to a loser because you're anchored to your entry, that's misbehavior. The next time you double your size to win back losses, that's misbehavior. So as we continue, remember this core principle. Markets are arenas of human misbehavior, and your survival depends not on denying it, but on mastering it. You've walked through every behavioral trap Thaler exposed: overconfidence, loss aversion, anchoring, fairness illusions, mental accounting. You've seen how they don't just live in academic papers, they live in your trading desk, bleeding your account day by day. Now it's time to stitch these lessons together and build something you can actually use. Because the ultimate promise of misbehaving isn't just understanding why humans fail, it's learning how to turn that failure into your edge. Here's the core truth. The market doesn't punish you for lack of intelligence. It punishes you for lack of discipline. Every trader has enough knowledge to succeed, but few can execute. Why? Because they deny misbehavior. They pretend they're rational, that next time they'll be stronger, that they'll magically avoid the same mistake. But as Thaler's entire career proved, misbehavior is the baseline. If you ignore it, you're doomed. If you embrace it, you can design around it, and that's where your edge begins. So how do you build your behavioral edge? Start with awareness. Journal your trades not just for technical data, but for psychology. Did you hesitate on entry? Did you move your stop? Did you size up recklessly? Label the bias, anchoring, overconfidence, fairness, revenge. By naming it, you strip it of power. You stop telling yourself, I don't know why I did that, and start saying, I misbehaved because of X. That clarity is priceless. Next comes structure. Build nudges into your process. Pre-program stops so you can't override them. Fix position sizing rules so you can't gamble on a whim. Cap daily losses to shut down tilt. Create friction around bad decisions. Make revenge trading harder, journaling mandatory, and impulsive entries inconvenient. Discipline isn't about heroic willpower. It's about designing an environment where misbehavior struggles to survive. Then, practice detachment. Thaler showed how attachment, the endowment effect, fairness illusions, loss aversion, twists decision-making. The pros solve this by treating trades as data points. One win doesn't make you a genius. One loss doesn't make you a fool. They are just outcomes within a distribution. Mark Douglas hammered this. Anything can happen, and your job is not to predict, but to execute consistently. Detachment is what allows you to survive variance without spiraling into revenge or arrogance. Finally, cultivate humility. The disasters of 2000, 2008, and every bubble in history were born from overconfidence. Traders believed they couldn't lose, that their models were flawless, that this time was different. It never is. Your humility is your shield. It keeps you cutting losers, sizing appropriately, and respecting risk even when the setup feels certain. Paul Tudor Jones tapes reminders to himself because he knows arrogance lurks at every corner. You should too. This is the behavioral edge: awareness, structure, detachment, humility. It's not glamorous, it won't make headlines, but it's what separates traders who flame out from those who endure. Remember, the market doesn't care about your intelligence, your passion, or your sense of fairness. It only cares about your ability to survive misbehavior, yours and everyone else's. So where does this leave you? With a choice. You can keep chasing forecasts, indicators, and fantasies of control, or you can accept the brutal truth Thaler revealed. You are human. You will misbehave, and that misbehavior will destroy you unless you prepare for it. The traders who thrive aren't the ones who eliminate flaws. They're the ones who design edges around them. Stop trying to be superhuman. Start building systems that let you succeed as the human you are. That's your real edge. Think about what you've just absorbed. Thaler's Misbehaving isn't just a history of behavioral economics. It's a mirror held up to your trading life. Every time you've clung to a loser, every time you've chased revenge, every time you've let fairness or ego dictate your decisions, you've been misbehaving. And every blown account, every busted streak, every sleepless night has been the price. But here's the liberating truth. Once you accept misbehavior as inevitable, you can prepare for it. You can design nudges, enforce structures, and cultivate humility that turns weakness into resilience. Your trading edge won't come from predicting the next candle. It won't come from outsmarting Wall Street. It will come from mastering yourself by embracing the fact that you're fallible and building systems that protect you from yourself. That's how the pros survive, and it's how you can too. So here's your call to action. Stop looking for perfection. Start journaling. Build nudges into your process. Cut your losers without hesitation. Treat every trade as a data point. And above all, accept that the market owes you nothing. If you're ready to take ownership of your psychology, you'll stop bleeding from predictable misbehavior and start compounding from consistent execution. If this breakdown opened your eyes, hit like, drop a comment with "I trade my behavior," and subscribe for more deep dives into the psychology of trading. Your next evolution as a trader doesn't start with another setup. It starts with mastering yourself. Have you ever sat there, staring at the screen, certain your setup is perfect, only to watch it unravel before your eyes? You told yourself you were disciplined. You told yourself you were objective, yet the same old mistake crept in. This is the world of biases, and Richard Thaler made it brutally clear. Cognitive traps don't just live in psychology textbooks. They bleed directly into your trading account. Biases are shortcuts your brain takes to make decisions faster, but in markets, speed without accuracy is a liability. Thaler cataloged countless examples where investors, managers, and everyday people consistently made irrational choices. For you, that means every time you trade, you're not simply battling the market, you're battling your own wiring. Let's start with overconfidence. You know that rush you feel after a winning streak, when you start increasing position sizes, skipping confirmations, and convincing yourself you've cracked the code? That's not skill. That's bias whispering in your ear. Thaler highlighted how people systematically overestimate their abilities, believing outcomes are more under their control than they really are. In trading, overconfidence leads to oversized bets and catastrophic drawdowns. Think about long-term capital management in 1998. Brilliant economists, Nobel laureates, and models that proved they couldn't fail. Yet their arrogance blinded them to risk, and they collapsed under market pressure. Overconfidence killed them, just as it kills retail traders every single day. Anchoring is another assassin. You've done it, anchoring on a price level or your entry point. You tell yourself, I bought at $100, so the fair value must be close to that. But the market doesn't care about your anchor. Thaler explained how people fixate on arbitrary reference points, skewing their perception of value. In trading, anchoring makes you cling to losing positions, or worse, misjudge potential entries because you can't let go of the high or low you've seen before. Jesse Livermore, the legendary speculator, warned against this nearly a century ago. The market is never wrong. Opinions often are. Anchoring is your opinion chaining you to the wrong side of the market. Now consider confirmation bias. Have you ever scrolled through Twitter or forums searching only for voices that agree with your position? That dopamine hit of finding someone else bullish on the same stock makes you feel safer, but it doesn't make you right. Thaler documented how humans cherry-pick data to reinforce pre-existing beliefs. In trading, that's a direct path to disaster. You'll ignore red flags, dismiss opposing signals, and double down when you should be cutting loose. Compare this to Brett Steenbarger's warnings in the Daily Trading Coach. The best traders seek disconfirming evidence, not comfort. If you're only listening to the echoes of your own opinion, you're misbehaving. Then comes loss aversion, the granddaddy of trading biases. Thaler, alongside Kahneman and Tversky, proved that humans feel the pain of a loss twice as intensely as the pleasure of a gain. That's why you've cut winners too quickly, but held on to losers until they've destroyed you. The math of markets says one big win can balance one big loss. But your brain doesn't see it that way. Your brain panics at red, freezes at pain, and drives you to make irrational choices just to avoid admitting you're wrong. Think back. Have you ever broken your plan because the thought of locking in a small loss felt unbearable? That's loss aversion choking your decision making. Recency bias is just as insidious. After a string of losses, you expect more pain and start trading timidly. After a string of wins, you expect more success and start swinging for the fences. Either way, you've abandoned your plan and allowed short-term outcomes to dictate long-term behavior. Thaler shows how humans overweight recent experiences, ignoring broader probabilities. For traders, this creates a cycle of emotional whiplash, overreacting to the last trade instead of executing the next trade objectively. All these biases aren't just quirks, they're recurring patterns that bleed your account slowly, trade by trade. They distort your perception, twist your discipline, and convince you that you're rational when you're not. This is why so many traders repeat the same mistakes for years without improvement. They're fighting the market instead of fighting their own psychology. Now, here's the hard truth Thaler forces you to face. You can't eliminate biases. You're human, and they're built into your wiring. But you can design safeguards. Journaling your trades exposes your overconfidence and anchoring. Risk management rules counter your loss aversion. Seeking out bearish arguments when you're bullish can check confirmation bias. Mark Douglas emphasized the same point. Trading isn't about predicting. It's about executing consistently within your edge. And consistency only comes when you acknowledge your biases instead of pretending you're immune. Think about your last month of trading. Can you map each bad decision to one of these biases? Did you size up recklessly after a win? That's overconfidence. Did you refuse to stop out because you were stuck on your entry price? That's anchoring. Did you ignore opposing analysis? Confirmation bias. Cut your winner too early? Loss aversion. Let your last 3 trades dictate your confidence? Recency bias. Once you see it, you can't unsee it, and that's your first step toward change. So ask yourself this right now. How much of your P&L is the market's fault, and how much is your bias leaking into your execution? If you're honest, you'll realize the market is just the mirror. It's showing you every flaw you've refused to acknowledge. Thaler hands you that mirror, and it's up to you to look long enough to make a change. Your mission isn't to become bias-free. That's impossible. Your mission is to accept that you will misbehave and then build a trading environment where misbehavior does the least damage. Safeguards, journals, risk limits, awareness. That's how you stop bleeding your account, one bias at a time. Picture this. You enter a trade at $75. The chart turns against you, drifting lower and lower until it's at $65. Any rational observer would say, cut it, take the loss, move on. But you don't. Instead, you mutter, it'll come back. I'll wait. I can't sell here. You've just stepped into one of the most dangerous psychological traps Thaler describes, the endowment effect. You've fallen in love with your position simply because it's yours. Thaler's research showed something profound. People assign more value to things once they own them. In controlled experiments, subjects demanded more money to give up a mug they had been given than they would ever have paid to buy it in the first place. Ownership distorted their judgment. Translate that into trading. The moment you click buy, your brain rewires the asset's value. Suddenly, you're no longer evaluating it objectively. You're protecting it, defending it, justifying it. That's the endowment effect in action, and it explains why traders cling to losers long past the point of reason. Ask yourself, how many times have you ignored your stop because you believed in the stock? How many times did you add more, convincing yourself you were right even as the market screamed otherwise? That wasn't strategy, that was attachment. You weren't trading the market anymore. You were protecting your ego. Thaler would call this misbehavior predictable, not random. And it's not just retail traders who fall for it. Fund managers, professional investors, even corporate executives display the same bias. They become married to positions, industries, or strategies, unable to let go even when data proves them wrong. Think of the dot-com bubble. Executives refused to abandon their inflated valuations. Investors clung to internet stocks as if their worth was guaranteed, and billions evaporated. Everyone was endowed with their own beliefs, and the market punished them for it. For traders like you, the danger is compounded by the speed of the market. A stubborn attachment to your entry price can spiral into cascading losses. One refusal to cut a loser becomes 2, then 3. Before long, your account isn't bleeding, it's hemorrhaging. And the cruel part? You'll justify it every step of the way, convincing yourself that this one is different. Mark Douglas warned about this in Trading in the Zone. Your job is not to be right, it's to execute your edge consistently. The endowment effect seduces you into trying to be right at all costs. You defend your initial decision because selling means admitting you were wrong. But markets don't reward pride, they reward adaptability. Now think about the flip side, the winners you cut too early. That's the endowment effect working in reverse. You take quick profits because you can't bear the thought of losing what you already own. You value the gain in your account so highly that you kill the trade before it reaches its true potential. Once again, ownership distorts rational judgment. Instead of letting your winners run, you protect them like fragile glass. What's the lesson? You can't afford to fall in love with your trades. You must treat every position as a tool, not a treasure. Your job isn't to protect it, it's to manage it according to your rules. Thaler's experiments prove this is hardwired misbehavior, but acknowledging it gives you the power to counteract it. How? First, externalize decisions. Write your exit strategy before you enter. Set stops and targets, then hold yourself accountable. If you keep the decision in your head, you'll twist it once ownership clouds your thinking. Second, review your trades objectively after the fact. Did you hold a loser longer than your plan allowed? That's the endowment effect. Did you take profits prematurely because you wanted to lock them in? That's the endowment effect. Journaling reveals these patterns, and awareness is the first step to change. Third, embrace humility. Accept upfront that you will be wrong, often. Thaler's entire critique of traditional economics rests on this truth. Humans misbehave, and pretending otherwise is dangerous. As a trader, admitting you'll misbehave allows you to design systems that protect you from yourself. Think about Paul Tudor Jones, who famously said his greatest mistake was holding on to losers early in his career. He taped a reminder above his desk: losers average losers. That wasn't a technical lesson, it was psychological. He was fighting the same endowment effect you face daily. So let me challenge you. What positions are you married to right now? Which trades have you turned into personal battles, refusing to let go because they feel like yours? The sooner you cut the cord, the sooner you return to trading reality instead of trading ego. Markets don't reward attachment, they reward flexibility. Thaler's endowment effect is the invisible hand pulling you into stubbornness. But once you name it, you can fight it. Every trade you enter is just another opportunity, not your child, not your identity, not your proof of intelligence. Break the marriage. Protect your account, not your pride. Have you ever promised yourself you'd follow the plan tomorrow, only to break that promise the moment the heat of trading hits? That's not because you're weak. It's because self-control under fire is one of the hardest battles you'll ever fight. Thaler exposes this tension vividly in Misbehaving. Humans don't just miscalculate, they self-sabotage. You tell yourself you'll act rationally, but in the moment, emotions hijack the controls. Think about dieting. You decide you'll eat clean all week, but when the plate of fries hits the table, your willpower evaporates. The same thing happens in trading. You plan to risk only 1% of capital per trade, but when that red candle pierces your stop, panic overrides discipline. You move the stop, you double down, you gamble to win back control. Rationally, you know better. But rationality has left the room. Thaler links this collapse of self-control to what psychologists call present bias. We overweight immediate gratification at the expense of long-term goals. In markets, that's the thrill of getting back at the market after a loss, or the high of chasing a breakout even when your plan says wait. It feels good now, but it wrecks you later. And the kicker? You'll rationalize it after the fact. You'll convince yourself you made a tactical adjustment, when in truth, you just misbehaved. The 2008 crisis wasn't just about bad math. It was about bad self-control. Banks and traders ignored long-term risk because the short-term rewards of subprime lending were irresistible. The same pattern plays out in your own account. One trade at a time, you let immediate impulses override the bigger picture of consistency and survival. Mark Douglas warned about this in Trading in the Zone. Discipline isn't about predicting outcomes. It's about sticking to your process no matter how uncomfortable it feels. But here's the trap. Your brain hates discomfort. Thaler shows how people systematically avoid pain, even at massive future costs. That's why you move your stop. The pain of realizing a loss feels unbearable, even if protecting your account is the right move. Richard Thaler describes this in The Mental Game of Trading. Tilt happens when emotions overwhelm execution. Maybe it's anger after a loss, greed after a win, or fear of missing out. Self-control evaporates and you start gambling instead of trading. Sound familiar? It should, because every trader eventually hits this wall. The difference between blowing up and breaking through is whether you design systems that account for your lack of self-control. So how do you fight back? First, automate discipline wherever possible. Use hard stops in your platform, not mental ones. A mental stop is just an invitation for your impulsive self to take over. If you've ever told yourself, "I'll cut it if it drops 2 more points," you already know how unreliable that is. Second, reduce decision fatigue. Every extra choice you make drains willpower. Thaler's insight is clear. The more complex the environment, the more likely you'll misbehave. Simplify your trading process. Predefine your setups, your risk, your exit criteria. The less you leave to heat-of-the-moment judgment, the stronger your self-control will feel. Third, recognize your trigger points. Which emotions consistently sabotage you? Is it frustration after 3 stop-outs? Is it euphoria after a big win? Is it boredom on a slow day? Thaler suggests mapping these patterns so you can anticipate when you're most vulnerable. Self-control isn't about being perfect. It's about preparing for your weak spots before they control you. Look at the pros. Paul Tudor Jones once admitted that his greatest skill wasn't predicting markets. It was disciplining himself to never let a trade get out of hand. He made mistakes, but he cut them fast. He understood that protecting capital required acknowledging his own lack of self-control. If billion-dollar hedge fund managers can admit it, so can you. Here's the wake-up call. The market doesn't care about your intentions. It only sees your actions. You can write the most beautiful plan, but if you break it under pressure, it's worthless. Thaler reminds you that humans consistently fail to align intentions with behavior. That's misbehaving. And unless you accept it, you'll keep sabotaging yourself. Think back to your last blow-up trade. Was it really the market's fault? Or was it your collapse of self-control? Did you overtrade after a loss, chasing to get even? Did you size up after a win, hungry for more? Did you move your stop, convincing yourself it was too tight? Be honest, because until you face these truths, you'll repeat them. The good news? You don't need to be perfect. You just need to design guardrails that keep your worst impulses from destroying you. Thaler shows that misbehavior is the norm. The traders who survive aren't the ones who eliminate it. They're the ones who build systems strong enough to withstand it. So here's the challenge. Stop pretending you'll suddenly be disciplined tomorrow. Instead, build structures today that make misbehavior harder. Lock in stops, predetermine size, write rules and follow them even when it feels unbearable. Because self-control isn't about willpower, it's about preparation. And in trading, preparation is the only thing standing between you and ruin. Imagine 2 traders. One just booked a $1,000 profit and feels invincible. The other just lost $1,000 and feels crushed. Both step back into the market, but here's the twist. They're not trading the same market anymore. They're trading through the lens of their recent outcome, separating wins and losses into mental boxes instead of treating them as one continuous flow of probability. This is the heart of Thaler's concept of mental accounting, and in trading, it can quietly destroy your edge. Thaler's research showed that people don't evaluate money objectively. Instead, they assign it to categories in their minds, treating each category differently. Think of the way gamblers treat house money differently than their original stake. In theory, $1 is $1, but in practice, it feels safer to risk profits than principal, so gamblers often take irrational risks once they're up. Traders do the same. You've probably said it. I'm just risking profits on this one. That little phrase is mental accounting at work. But here's the danger. The market doesn't care whether your dollar came from profits or capital. It's all the same money, and it's all at risk. By separating it in your mind, you loosen your discipline. You size bigger because it doesn't count. You chase because you feel insulated. And before you know it, the profits you worked so hard to earn vanish because you treated them as play money. Now flip the script. Losses create their own mental accounts. Maybe you've told yourself, I just need to make back what I lost this morning. That's revenge trading, pure and simple. You're no longer trading the setup in front of you. You're trading a psychological ledger, trying to balance red with green. Thaler found that humans hate leaving accounts unfinished. That's why you stay in bad trades or force new ones, desperate to close the mental book. But in trading, forcing closure usually means forcing losses. Think back. How many times have you set daily, weekly, or monthly P&L targets? On the surface, it sounds disciplined. But the moment you tie yourself to those arbitrary boxes, you're vulnerable. You'll pass on good trades if you've already hit target. You'll take reckless trades if you're behind. Either way, you're no longer aligned with the market. You're aligned with your mental accounting. Mark Douglas warned about this trap in Trading in the Zone. The market does not know or care about you. Yet mental accounting makes you act as if the market owes you balance. If you're down, you demand it give you back. If you're up, you demand it lets you play with house money. Both attitudes distort your objectivity. Thaler showed that even corporations fall victim. Executives might keep different budgets mentally separated, overspending in one area while starving another, just to preserve the illusion of control. Traders replicate this when they treat different accounts or different strategies as isolated. This is my swing account. This is my scalp account. In reality, every trade affects your net capital and your emotional state. Splitting them into categories doesn't protect you, it blinds you. So how do you counteract this? First, unify your risk. Whether you're up or down, whether it's morning or evening, whether it's account A or account B, every trade should follow the same risk framework. If your rule is 1% risk per trade, it applies always. No house money exceptions. No just for fun trades. No I'll get it back gambles. A dollar is a dollar. Treat it that way. Second, track cumulative performance, not isolated pockets. Mental accounting thrives when you look at fragments. This trade, this day, this week. By zooming out to longer horizons, you remove some of the emotional weight of any single box. This aligns with how pros think. They don't obsess over one trade. They obsess over execution across thousands. Third, build awareness of revenge triggers. Every time you feel the urge to get it back, pause. That's your brain opening a mental account it desperately wants to close. Write it down. Acknowledge it. Then refuse to feed it. Remember, revenge trading isn't strategy. It's misbehavior disguised as discipline. Thaler's mental accounting insight forces you to ask, how much of your trading is truly based on strategy, and how much is just you juggling psychological ledgers? Are you trading setups, or are you trading stories you've invented about your P&L? Consider this. The best traders in the world don't let yesterday's results dictate today's process. They show up fresh, knowing that every trade is independent. But if you're caught in mental accounting, you drag emotional baggage from one decision to the next. That's not just costly, it's fatal. So here's your wake-up call. Every time you say, it's just profits, or I'll get it back, stop. That's the exact moment Thaler would say you're misbehaving. In markets, misbehavior doesn't just make you look foolish, it empties your account. Discipline means treating every dollar, every trade, every decision as part of one unified system. No separate boxes, no excuses, only the truth of probability, risk, and execution. Have you ever screamed at the screen, furious that the market isn't fair? You followed your plan. The setup was textbook, the breakout looked clean, and yet the price reversed, stopped you out, and then immediately ran in the direction you predicted. In that moment, you weren't just upset at the loss, you were outraged at the unfairness of it all. Richard Thaler would tell you this is no accident. The illusion of fairness warps human behavior, and in markets, it warps traders into self-destruction. Thaler studied fairness in everyday life, why people reject unfair offers, why they punish others even at their own expense, why they expect reciprocity where none is promised. One famous experiment, the ultimatum game, proved that people would rather receive nothing than accept a deal they perceived as unfair. Rationally, taking something is better than nothing. But fairness overrides logic. Traders, too, let this illusion twist their judgment. In trading, fairness looks like this. You expect the market to reward good behavior and punish bad behavior. You expect your effort to pay off. You expect the market to respect levels because they should hold. You expect your losses to eventually be compensated by wins, as if there's a cosmic ledger balancing everything out. But the market doesn't operate on fairness. It operates on probabilities and psychology. When you demand fairness, you set yourself up for tilt. Think about revenge trading. At its core, it's a fairness illusion. You feel wronged, cheated by the stop hunt, manipulated by market makers, betrayed by your setup. So you demand retribution. You double down, not to make money, but to get even. This is you punishing the market for being unfair, even if it costs you more. That's the ultimatum game playing out in your account. Or consider when you refuse to trade after a string of bad luck. It's not fair, you say, I did everything right. That belief traps you. Instead of calmly continuing with your edge, you freeze, waiting for the market to treat you better. But the market doesn't know you. It doesn't care about your plans, your discipline, or your frustration. It will not bend to your sense of fairness. Mark Douglas hammered this lesson in Trading in the Zone. Anything can happen. One trade means nothing. The only edge you have is executing consistently over many trades. But when fairness illusions cloud you, you start looking for justice in individual trades. That's why you can spiral after one bad day. You weren't just hurt financially, you were hurt morally. And that pain lingers. Thaler also showed that fairness expectations shift with context. People tolerate higher prices for snow shovels during storms, but call it unfair. If a store raises prices just because it can. In markets, the same shift happens. You accept slippage in volatile conditions, but call it manipulation in calmer ones. You excuse your bias when it fits your story, but condemn the market when it doesn't. Fairness becomes subjective, and that subjectivity blinds you to reality. Here's the truth. Trading isn't fair. Some traders have better tools, faster access, deeper capital. Algorithms will front-run you. Market makers will trap you. Big players will manipulate flows. If you expect fairness, you'll fight battles you cannot win. But if you accept unfairness as the baseline, you free yourself from illusions. You stop wasting energy demanding justice and start focusing on the only thing you control, your decisions. Think of poker. Skilled players don't cry about fairness when amateurs suck out on them with bad hands. They accept variance as the price of the game. Over time, their edge wins. Traders must think the same way. If you keep expecting justice from the market, you'll burn out emotionally. If you accept randomness, you'll last long enough for your edge to work. So how do you inoculate yourself against fairness illusions? First, reframe losses. Stop calling them unfair. Call them data points. Each loss is feedback, part of the distribution. Second, detach morality from outcomes. A good trade can lose, a bad trade can win. Your job is not to enforce fairness, but to execute rules. Third, build emotional distance. When you feel cheated, don't react. Step back, breathe, remind yourself, the market owes me nothing. Paul Tudor Jones said it best, don't ever average losers. Why? Because averaging down is often a fairness reaction, refusing to let the market win. He accepted reality instead of demanding fairness, and that humility preserved his fortune. So let me ask you, how many of your worst trades were fueled not by logic, but by anger at unfairness? How much capital have you thrown away just to prove a point? If you're honest, you'll see the pattern. And once you see it, you can break it. Thaler's insight is brutal but liberating. Fairness is a myth. The market is chaos, psychology, manipulation, and probability. The sooner you kill your need for fairness, the sooner you'll stop punishing yourself for what was never in your control. Picture your trading desk, screens glowing, alerts pinging, charts flashing. Your head is buzzing with signals, biases, and emotions. You're one impulse away from sabotaging yourself. Now imagine the environment quietly working for you instead of against you. Stops execute automatically. Journals remind you of yesterday's mistakes. Position sizes are capped before temptation creeps in. You didn't suddenly gain more willpower. You designed nudges. And this is exactly where Thaler's work in Misbehaving becomes practical. Nudges are subtle changes in process and environment that steer you toward better behavior without needing brute force discipline. Thaler and Sunstein made nudge theory famous with their book Nudge, but the foundation is already present in Misbehaving. The insight is simple. People misbehave predictably, so instead of demanding perfection, build systems that gently guide better choices. Traders who fail often believe success is about raw discipline. Tomorrow I'll be stronger. Tomorrow I won't break the plan. But you and I both know that doesn't last. Stress comes, emotions rise, and willpower evaporates. Nudges bypass that weakness. Let's make it concrete. Suppose you struggle to honor stops. You promise to obey them, but in the moment, fear and ego take over. A nudge solution? Use hard stops in your platform, no exceptions. The environment executes discipline for you. Or suppose you overtrade when bored. A nudge? Limit your maximum number of trades per day through automation or accountability. Once the cap is hit, you're done. These tiny interventions reduce the reliance on fragile self-control. Think about saving for retirement. Thaler showed that people rarely contribute unless they're automatically enrolled, but once enrollment is the default, participation skyrockets. Traders can mimic this. Default to risk management, default to smaller size, default to pre-written plans. Remove the friction of doing the right thing and add friction to doing the wrong thing. Want to revenge trade? Make it inconvenient. Close the platform, journal the loss first, or require a cooling off rule. The harder it is to misbehave, the easier it is to stay consistent. Compare this to Mark Douglas's teaching. The goal is consistency, not prediction. Nudges help enforce consistency by shaping the path of least resistance. Richard Thaler, too, stresses designing routines that reduce tilt triggers. You don't fight emotions head-on. You redirect them. Think of it like bumpers in bowling. The bumpers don't make you a pro. They just keep your ball from crashing into the gutter every time. Nudges also help with position sizing. Many traders blow accounts not because they can't find setups, but because they can't control size under pressure. A nudge? Pre-program fixed risk per trade. If you always risk 1% of capital and it's coded in, you don't get to feel your way into bigger bets. You've removed the temptation before it arrives. Here's another. Journaling. On its own, journaling is just a habit. But if you design it as a nudge, forcing yourself to log trades before entering the next one, it becomes a circuit breaker. That pause can save you from impulsive spirals. Brett Steenbarger often writes about this. The act of structured reflection interrupts emotional feedback loops. Thaler's brilliance is in showing that humans don't need massive overhauls to change. They need smart tweaks. Traders chase the fantasy of complete discipline when what they need are structural nudges that keep them aligned. You don't need to conquer fear, greed, and tilt every day. You just need to set up rails so that when misbehavior comes, it doesn't derail everything. Now ask yourself, what's the smallest tweak that could save you from your biggest repeated mistake? If it's moving stops, then lock them in. If it's overtrading, then cap your entries. If it's tilt, then force breaks after losses. Stop demanding perfection of yourself. Start designing for your flaws. That's how professionals operate. They know their weaknesses and build nudges to protect against them. Think of Ray Dalio's principles at Bridgewater. He doesn't rely on willpower. He builds systems that enforce rules. Or Paul Tudor Jones taping reminders like losers average losers above his desk. Those aren't motivational quotes. They're nudges. They push the brain toward better defaults in high-stress environments. So here's the truth bomb. You're not failing because you lack knowledge. You're failing because your environment makes misbehavior easy. Thaler would say the solution isn't to lecture yourself harder. It's to design better defaults. Trading is already brutal enough. Why fight your own wiring when you could guide it? Your mission is simple. Turn every repeated mistake into a design problem, not a discipline problem. Build nudges into your process until good behavior becomes the path of least resistance. The best traders don't rely on superhuman willpower. They rely on structures that make doing the right thing almost automatic. And once you embrace that, you stop bleeding energy fighting yourself and start channeling it where it belongs. Reading markets, managing risk, and executing cleanly. How many hours have you spent searching for the perfect forecast? The indicator that never fails, the strategy that always predicts direction, the setup that will finally make you certain. Be honest, you've chased it. Every trader has. But Thaler's Misbehaving delivers the punchline. Prediction is a trap, because humans are terrible forecasters. And the more certain you feel, the more likely you're falling into bias, illusion, and eventual disaster. Thaler's research reveals how consistently people overestimate their ability to predict outcomes. In markets, this shows up as the belief that your analysis gives you control. You believe the chart should respect support, or the economy must respond to policy, or earnings will move price logically. But markets are not logical machines. They're human theaters. They misbehave. That's why the efficient market hypothesis collapsed under the weight of real-world anomalies. If markets were perfectly rational, bubbles, panics, and crashes wouldn't exist. Yet they do, and they devastate anyone who confuses forecasting with control. Think of the housing crash in 2008. Every model said prices would keep rising. Every rating agency predicted safety. Investors convinced themselves they could see the future. But they weren't forecasting. They were hallucinating. And when the illusion broke, trillions evaporated. Traders do this on a smaller scale every day. You convince yourself you know what will happen next, then size up, ignore stops, and collapse when reality diverges from your fantasy. Mark Douglas said it bluntly in Trading in the Zone. Anything can happen. Your edge is not prediction. Your edge is execution. Yet your brain resists this truth. It craves certainty. Thaler explains why. Uncertainty feels uncomfortable, so we fill the gap with overconfidence and illusion. You've felt it. Those moments when a trade feels so certain you'd bet everything. That feeling isn't insight, it's bias tricking you. Consider confirmation bias. Once you predict a move, your brain hunts only for evidence that supports it. You scroll Twitter for bullish voices, ignore bearish signals, and dismiss contrary analysis. You think you're forecasting, but really you're just fortifying a belief. Or anchoring. You see a level and assume price must return there. You treat it as destiny when it's just a line on a chart. These traps make you a prisoner of your own predictions. The great traders flip the script. Instead of predicting, they adapt. Paul Tudor Jones doesn't obsess over being right. He obsesses over cutting losses fast when he's wrong. Ray Dalio doesn't pretend to know the future. He builds portfolios that thrive in multiple scenarios. They understand Thaler's point. Prediction is fragile, but adaptability is durable. For you, this means shifting focus from what will the market do to how will I respond when the market does what it does. That shift changes everything. You stop chasing certainty and start building resilience. You stop fighting to be right and start fighting to stay in the game. And in trading, survival is the only way to let your edge play out. Think about poker again. The best players don't know which card is coming next. They don't pretend to. They manage probabilities, size bets, and protect themselves when odds turn. Trading is the same. Yet how often have you bet like you knew the next card? That's prediction illusion, and it's draining your account. Here's the paradox. Once you stop demanding prediction, you actually see more clearly. You're no longer blinded by the need to be right. You're open to new information, ready to adjust, and free to execute without ego. Thaler's entire career proves that humans are predictably irrational. Your job isn't to rise above that truth. It's to build a trading process that thrives despite it. So, how do you escape the prediction trap? First, reframe your trades. Stop asking, will this work? Start asking, what's my plan if it works, and what's my plan if it doesn't? Second, track execution, not outcomes. Judge yourself on whether you followed rules, not whether your forecast was correct. Third, embrace probabilistic thinking. Every setup has a distribution of outcomes. One loser doesn't make you wrong, and one winner doesn't make you right. It's the long series that matters. Remember what Douglas drilled into traders. Your goal isn't to win every trade, it's to consistently execute edge. When you internalize that, losses stop feeling like betrayal. They become data points. And data points are neutral. They don't insult your ego. Now pause. How many times in the past month did you size up because you were sure? How many times did you ignore your stop because this one is different? How many times did you spiral because your prediction didn't come true? Those aren't market problems. Those are prediction problems. The market doesn't demand you be a prophet. It demands you be consistent, resilient, and humble. Thaler rips the veil off the forecasting fantasy. Prediction is a trap. Adaptability is your real edge. If you want to survive, stop asking the market to validate your predictions and start asking it to test your preparation. Close your eyes and replay your last meltdown trade. The one where you broke every rule, doubled down, maybe even blew up an entire week's profits in an hour. What was really happening? You weren't just trading charts. You were replaying the same behavioral failures Richard Thaler cataloged in Misbehaving. The story of markets is the story of human misbehavior, repeated in cycles, destroying those who refuse to learn. And if you don't face these lessons head on, you'll keep starring in the same tragic script. Thaler's work is full of market parallels. Think of the tech bubble of the late 90s. Traders and investors poured into internet stocks with no earnings, no business models, no future, but overflowing hype. Rational valuation disappeared. Overconfidence and herd behavior took over. People anchored to outrageous price targets, dismissed risk, and believed they couldn't lose. Sound familiar? You may not be buying pets.com, but every time you chase a parabolic breakout without risk control, you're reenacting the same bias. You're the bubble, just on a smaller scale. Or take 2008. Mortgage-backed securities were packaged as safe because models said defaults were uncorrelated. Everyone misbehaved. Banks overleveraged, investors ignored risk, regulators assumed rationality. But when housing prices turned, the illusion collapsed. That disaster wasn't an outlier. It was the predictable result of behavioral flaws compounding unchecked. Traders fall for the same illusion when they believe their system is bulletproof. You think correlation, volatility, or trends will hold forever. Then a black swan hits, and you realize you weren't trading reality, you were trading faith. Thaler also highlights how mental accounting fuels bad decisions. Traders keep score trade by trade, day by day, instead of thinking in probabilities across thousands of trades. That's why you revenge trade, because you can't leave a red day in your mental ledger. Or you size up recklessly after a win, calling it house money. But the market doesn't respect your categories. It punishes them. And don't forget loss aversion. Thaler proved that losses hurt twice as much as gains feel good. That's why you hold losers far past reason and cut winners prematurely. But over time, this flips the expectancy math against you. Your losers grow, your winners shrink, and your account trends down no matter how many setups you find. The math of trading is neutral. It's your behavior that bends it negative. The sobering truth? You're not special. Your psychology isn't unique. The same biases that drove tulip mania, dot-com bubbles, and subprime crises are alive in your own brain every time you log in. Thaler's entire argument is that misbehavior isn't random, it's systematic, which means your repeated trading mistakes aren't random either. They're predictable. They'll keep happening until you admit they exist and design against them. Mark Douglas said, "You don't trade the markets, you trade your beliefs about the markets." Misbehaving traders believe in fairness, prediction, control, and ego. And those beliefs are lethal. The professionals, they strip away illusion. They know losses are part of the game. They know anything can happen. They know their job is not to predict, but to execute. That shift isn't just philosophical, it's survival. So how do you integrate these lessons? Start with brutal honesty. Track your misbehavior as diligently as your setups. Journal not just entries and exits, but emotions, biases, and impulses. Which mistakes repeat? Anchoring? Overconfidence? Fairness illusions? Once you name them, you can design nudges, guardrails to keep you from acting on them. Without that awareness, you're just another gambler misbehaving in predictable ways. Second, zoom out. Stop obsessing over the fairness of one trade or the outcome of one day. Pros think in years, not minutes. They know their edge only emerges across large sample sizes. If you can't detach from short-term noise, you'll never see the long-term truth. Third, embrace humility. Every blow-up in history came from arrogance, thinking this time is different. It never is. The players change, the assets change, but the misbehavior stays the same. Your only chance at survival is to accept that you are vulnerable too. Think of Jesse Livermore, who made and lost fortunes multiple times. He was brilliant, but his inability to manage his own psychology doomed him. Compare that to traders like Ed Seykota, who thrived by staying ruthlessly aligned with systems and cutting losers without hesitation. Both men saw the same markets. The difference was how they handled misbehavior. So let me ask you directly, which side are you leaning toward? Are you repeating the same predictable errors, convinced you'll outsmart them next time? Or are you finally ready to face them, name them, and design against them? Because if history teaches one thing, it's this: the market will always exploit misbehavior. The only question is whether you keep falling for it or finally evolve.